One.
For yous have been watching the show for a long time and know that usually on Fridays before a Michigan football game, I wear a Michigan shirt. But you know what? It's a special occasion. Restore the roar. Could it be a Lions Dolphins Super Bowl? What would that do to the karma of this show? Enough sports. I know you guys hate that. S&P's up 16. Can the rally hold? We got some numbers at 8:30. Nike, holy Nike. We got to talk about Nike. And let's see if we can figure out whether or not this rally is going to hold. It's Friday. I'm fired up. It's pre-market prep.
Coming to you live from downtown Detroit, this is Benzinga's Pre-Market Prep with your hosts, Joel Elconin.
This is a volatile puppy here, isn't it?
And Dennis Dick.
I'm bidding a penny. I'd buy that stock for a penny.
With everything you need to start your trading day.
Good morning, traders and investors. You can tell we're all fired up today on pre-market prep, the real pre-market prep. We're up 17 handles at 43.54.50. Caught a bid during the after hours pre-market session and just off the high of the day, 61.50. The dollar pulling back. That's helping things. It's down 40 cents. The bonds up a half a point. We got a lot to talk about the bonds and the TLT at 114 and 132nd. Crude will not surrender the $90 handle, up $1.34 at 93.05. Gold up 710 at 1885.80. Silver up much more on a percentage basis. That's up 61 cents at 23.35. And Bitcoin down $215 at 27,140. We got to bring in Triple D on the hop, and we got to bring.
We're not allowed to talk any sports on the show. We won't talk about sports whatsoever. This is a stock
You
show.
win one game and you see what happens.
Any sports whatsoever. No dominance in Green Bay. None. We will talk no sports. So go no sports.
We won't talk Tua, who the Lions could have had in a draft. Right, but they passed on him. Tua hangs up 70 on the Broncos last week. I mean, come on,
time, Detroit, Michigan, man.
This is our
Prime
time, baby. Okay, we cannot talk about the team that's not to be mentioned because people don't like talking with the Lions.
All right. Let's go straight to it. Let's talk all about. Look, everybody, look down.
The field.
Everybody, look down. Are you wearing shoes?
Let's be honest here. Oh yeah, it's Forward Down the Field. The corniest song ever. I still love it though.
Well, hey, Ford better get their act together because more strikes coming soon. We'll talk a little bit about that, but let's get into the Nike action. Nike report, of course, the biggest report of the day. Going to continue to watch to see when we get Carnival, but you guys let me know. Scream at me in the chat when you guys see that hit the tape. Nike here, EPS 94 cents, beats the 74-cent estimate. Sales of $12.93 billion, missed the $12.98 billion. Nike executives said member engagement within D2C business up double digits versus last year. Also said to expect to report revenue to growth mid-single digits for the full year. North America sales were down 2% year over year. Greater China sales were up 5%. European sales climbed 8%. Asia Pacific and Latin America sales were up 2%. Nike direct revenues were up 6%. And then Nike's brand digital sales also increased 2% here. Wholesale revenues were flat.
The whole reason Nike is trading up 9% here this morning is that expectations were absolutely in the gutter. There was nothing really great in this report, but it one, reported on the right day because we had a huge reversal in the overall market. So they were hungry for stocks. And two, they're like, it's good enough. Let's go. Let's buy. And then the call and the guidance was okay. Everything was just okay at Nike. This is not like, oh my goodness, did you see that Nike report? So you're getting a nice pop. It's a relief pop. Major resistance up at $100. basically just because expectations were in the gutter going into the print.
I don't know if we talked about this on the closing print, but I mean, you look at that upper right chart, and hey, you ever seen a more bullish chart? I mean, how could you be short going into the report with something like that? I mean, it just, yeah,
I'm
and like,
telling you, man.
I
Those
mean,
are
you
the
just
ones you want to be
what
going
want,
long
man?
into the reports.
I
This is
know.
how it works. When they're going straight up, you want to be short going to the report. When they're going straight down, you want to be long into the report. That's the way this earnings season worked. I mean, we're at the end of it now, but that is totally the way this earnings season worked. It's a simple game, folks. It's a simple game.
18
Better talks about this all the time in the chat. I do too. Expectations low, easy to beat, low bar. Expectations high, like, go back to the NVIDIA quarter. That was amazing, and they sold off on it. It's all about expectations.
Mitch, what did you say about the B2C? Could you just repeat that? Because I've just noticed less Nike stuff in the stores, and maybe they're trying to get people more direct and not go through the stores. Was that something that
Yeah,
was put in?
D2C business up
Yeah,
double digits versus last
yeah,
year. And
yep.
so one thing that we've seen Nike completely make the move in is that before it was like, okay, how can we get this into all the shoe retailers out there, every store? Now it's okay, let's just give them some models
Mm-hmm.
and let's
Mm-hmm.
keep some models and let's actually just sell it directly to the consumer. And this is the move that we're seeing what's really affecting Foot Locker, right? And that's what's really giving them the hit is that more and more companies are looking at D2C, and that actually helps them with expenses, right? They're just able to keep it at the Nike factory versus shipping it to Foot
Yeah.
Locker, then them having to go ahead and ship it to their stores, put it out.
Oh
I
yeah,
think
and
in the
pay them,
long
and
run,
pay them too. Yeah, yeah.
there's
It
no
makes
point in
total.
Nike
Yep.
doing anything else but selling it directly to you.
Gonna try and fill a gap here up to 99.03, and Dennis mentioned the psychological $100 level. So, if you have a top profit target in this area, you know, take it 97, 98, 99. I almost looked at the straddle in this thing too, because I was thinking, man, this can't move 5, 6, $7, and here it is up $8.50. I think a little bit longer term, we'll see what happens with this move. If it's just a gap and go and it builds on it, what I would like to see some kind of pullback. I don't think we'll get to the top of yesterday's range at 89 and change. So let us settle out 100 big psychological number.
Obviously, sympathy moves here.
Yep.
Lululemon, Under Armour. You think about those.
About the
Under Armour's getting a
Crocs.
pretty good lift. And all Deckers. You could go into you can go into all those Dick's Sporting Goods, Deckers, Crocs, Skechers, ONON. Retail in general, I think retail will have a decent day because this helps, because retail's all been in the gutter. So think about all the potential sympathies, all kinds of different peers to look at on this Nike report.
One that has been coming back to the gap that remember when it got the lift was On Holdings. Remember that one? It's been coming back towards the gap, and it's been bouncing off this 25, like 75 area multiple times. Now the question is, is this one going to get the lift back or going to hit that gap zone?
It's getting it right today. It's up 4% with this obviously sympathy move with Nike. I think you come to a logical area of bouncing. I think that's what the stock market did on a lot of stocks. You've come down quite a bit. Like we were saying, there's a lot of stocks that have gone down to support. There's a lot of stocks that haven't sold off, like Apple, but there's a lot of stocks that have been hit pretty hard. And I mean, Anna is one too. That was a storied stock that was trading, up just over, well, not even that long ago. I mean, we talked about a month and a half ago. This thing was $37, now 25. I mean, this is what Kramer stock. It's been pitched by social media. It's the future of retail. I mean, I've heard all kinds of stuff on. And it goes on and on. But $25, that's probably a decent psychological level of support.
As you dive deeper into this report, one comment that was given by Nike was cautiously planning for modest markdown improvements for the balance of the year given the promotional environment. So what are they saying there? They're pretty much looking at what? Well, they're going to have to mark down some of these shoes to get them sold this holiday season, and that they're looking at others really kind of giving that promotional environment. So you could see some markdowns and maybe hurting their own margins just so that it can get those sales that they need, especially coming up with the holiday season.
They're sharp shoes. Have you seen them, Dennis? Do people
No.
wear them in Canada?
No,
They're
I haven't
sharp.
seen 'em.
They're not. A lot of them are not. They're like slip-ons. They're not. A lot of them are not lace. Laces. And like when I'm in the gym, doing lifting or what. I mean, I like tie. I like good support, but they look good. Roger Federer, is behind it. To me, that's
What's a
just
pair of those shoes cost?
I bet you they're not cheap. I bet you they're.
100 to 160, somewhere in that range, just like a Nike shoe.
Well,
Let's
that's
just be
not
honest.
bad.
I'll try them on. I'll try them on next time I buy a pair of shoes. For me, this is a really tough chart. I mean, you got the gap in April, or excuse me, the gap in It's just a gappy all over the place. You got the upside gap. I mean, I'd be a buyer all day at $22, but when's he going to get to $22, right? When it triple tops. So hard to give technicals on this with such a gappy stock. If I did had to give one level, if you stretch my arm behind my back, I would say 27.50 is your 3 and 4 day highs.
Let's keep moving here. Blue Apron shareholders to receive $13 a share via a tender offer from Wonder Group. I don't know what the Wonder Group is, or if they should be going after Blue Apron. Have you guys ever gotten Blue Apron delivered?
No.
In the chat, let me know.
This was a shocking takeover to me. So there's a lot of stocks that look like Blue Apron. The storied stocks from 2022 that are absolutely in the gutter. Maybe there are some diamonds in the rough here. I did not think Blue Apron was a diamond in the rough. I wouldn't have anticipated this gets taken over for 120% premium or 130% premium, but that's exactly what has occurred. So congratulations, Blue Apron shareholders. I mean, if you've held for the last couple of months, you're doing pretty good. You held for the last couple of years, you're probably still hammered on it.
Is it the Wonder Group behind Wonder Bread?
I don't know. I was thinking
the all-time high on this puppy. You know what the all-time high is? Because must have had some splits or something, reverse splits.
Yeah.
$1,980.
Yep.
$1,980 a share. So if you bought it up there when everybody was hyping this thing when it came out, you were down a cool 99% still. But congratulations, you got the stock taken over.
Data use, is there Hello Fresh out there? Is there something like that? Yeah, and then we got something to Lisa tried it during the pandemic. It's just supposed to be really, but there was like, it was like 97 things you had to do. You might as well use your own recipes. But what cash takeout, $13. No one saw this coming. I mentioned Beyond Meat. Dennis said Beyond Meat's going to zero. I can't think of sympathy plays for this one really.
No, there's not even to worry about sympathy on stuff like this. I mean, there's going to be some stocks that are obviously mispriced. We have been hammered on a lot of stocks. I mean, all the storied stocks from 2020, 2020, 2021 that were, are going to take over the whole world. A lot of those are down 95 to 99%, and Blue Apron was one of them. So, I mean, is there some stocks that could get taken out, for premiums at these prices? Maybe, but some of those are also going to zero. I don't know which ones are getting taken out and which ones are going to zero. So that's where I'm still back to my valuation cap. There's some stocks here that are grossly mispriced and grossly been hammered, but I wouldn't have cited Blue Apron as one of them.
Yeah, this Mark Lohr started Wonder. It's a food delivery startup that operates truck-based restaurants from which consumers could order their own food through a mobile app. So this guy's just getting their customer base at a steep discount. So never heard of the Wonder Group. I thought of Wonder Bread too, Mitch, when it came up. But,
maybe it is.
The good old Wonder Bread. All right.
I bought some of that a couple days ago.
Well, the slice of bread isn't going good for the strikes out there. UAW 10 a.m. deadline for further strikes here. We haven't seen them really affect the stocks. Let's just be honest. And I think
the strike's in there.
The strike's in there. That's what you think, Dennis? It was just priced ahead of time.
Yeah, and there's going to be a lift when they eventually do get a deal, so you have to be careful of that. That lift, I believe, will be short-lived, so I think it'll be a selling opportunity, even a shorting opportunity. I do believe these are value traps, so I'm going to stick with that thesis. There are some stocks to buy out there, on the dips, but Ford and GM, I don't think are those stocks because I do think the CarMax was a little bit of a tell. I think the Ford and GM sales are going to fall off a cliff, even without the production here. I think demand's just going to fall off a cliff. And especially if they got to raise the prices because they get a new labor deal and those prices got to go up more. Who's paying $80,000 for a pickup? I mean, it's gone crazy. So you look at the prices of the dealership, I'm going to drive my car and then trucks longer. And that's what will happen. I mean, it's basically, what the dealerships are. It's like upgrade cycles. Every 3 to 5 years, a lot of people like to upgrade their vehicles. Well, people are going to be driving them more, longer. And that's not good for GM and Ford. And that's just because the pricing of them is just way too expensive.
And they're going after the dealers too by not, sending the supplies, the parts supplies. So it's really trickling down, and the consumer is the one that's, is going to be hurt. I mean, obviously there needs to be some kind of raise. I thought them coming down from 30% to 40%. Maybe that was a reason for the pop yesterday.
Did they come down to 30 now?
I thought I read that. I don't think I made that up. I think I saw that on Twitter, so it could be made up. But man, there's just got to be some kind of middle ground. But it's just gonna affect all of us. And
you know what my question, and I watched that Sully segment there. I don't know if you caught it, Mitch, just a couple days ago when he was interviewing all the people in Detroit. We love Detroit, but I mean, all in on these benefits, people are still getting, at this current time, it says $66 an hour, with the benefits and everything like that. And they're all saying they can't make ends meet. I mean, that's $130,000 a year. There's a lot of people in America that make a hell of a lot less than that and still try, can make ends meet. I don't know how you can't make ends meet on $66 an hour. I honestly don't. So I get it that GM and Ford. But they're on there and saying they have to have second jobs. Like the one person was like, I'm working Delta too. I work at Delta as well because I can't make ends meet. I've got a house and I've got a kid. $66 an hour. Maybe you should check your spending habits a little bit, because I feel like at $66 an hour, that's $120,000 to $130,000 a year. I think you should be able to make ends meet at that. So if you want to make the argument that GM and Ford are breaking in record profits and the CEO is making $300 million a year and we want a piece of that, that's fine. But getting on there and saying these people are hard up, I don't know if that's the case.
Let's go to upgrades and downgrades here. Getting out of the UAW conversation, Loop Capital upgrading Bumble to buy, announcing $18 price target. Bumble? I haven't heard Bumble mentioned in forever. Of course, this kind of trades with Match Group. If you want to look at a similar relationship here, this has been in the gutter. Is it starting to wake up maybe on this upgrade?
I think some of these stocks have all been in the gutter. I mean, this is where we've got to really give it perspective here, because we can look at the S&P and say, oh, it's sold off 6-7%. There are stocks down 40-50% in the last couple of months. Some of these stocks are oversold. I don't know if it's Bumble. I don't know if it's Square. I don't know if it's Dollar General. But all I know is we have had a crash in probably 20% of the stocks out there, maybe more than that, like a crash. Like we've fallen 40 to 50% in 2 months. Bumble, $22, $21 back in July, $14. That's $7 stock. That's a 34% fall. That the crash of 87 was a 27% fall. So you can basically say Bumble has crashed over the last 2 months. Is there some diamonds here? Is there some undervalued stocks? Maybe you should do some stock picking here. There's probably some opportunities in the rubble. I don't know if Bumble's one of them, but some analysts thinks it is.
That's the one where the ladies get to make the choice, right? Is that the dating app?
Yeah, you know all about that, Joel, right?
Oh yeah, I do.
Joel's on there. He's got his secret.
Got set up there. You set yourself up there, Joel.
What's the one? Ashley Madison or something? What's the other one?
Oh, Dennis.
Joe, tell about Joel's secret Madison account.
Oh yeah. Yeah.
You on the farmer one too, Joel? With that
farmer? There's a farmer one? I mean, if this could get over, is it over $15? Yeah, I mean, you had 3-4 highs right at the $15 area. Actually, 4 highs in a row. If it could hold a 15 bid, why not go to 15 and a half? As far as trying to buy this on a pullback, the top of yesterday's range was 1454. So just we just got to, after the show's over, I'm going to go and I'm going to look for the worst looking charts. And then I'm just going to go and buy those stocks. They just have to look Top of the
Sometimes
page
those are
to
the
the
buys. Sometimes
top of
those
the
are the
page,
buys.
bottom of the page. That's what I'm gonna look at. And what
It's
else
a
is?
contrarian market, folks. We have been in a contrarian market here for the better part of a year and a half. And the Momo traders can be out there and say, yeah, we just buy momentum. But I tell you, if you were just buying momentum a month and a half ago, you're long stuff like on and losing 30%. So, I mean, you have stop outs, but there's always pockets of momentum. But contrarian trading has worked. When the stocks are going down and looking like hell, they've been buys in the last year and a half. And when they're going straight up and looking awesome, they've been sells. So we are in and still remain in a contrarian market.
Bank of America boosted its rating for Bud to buy from neutral and assigning a price objective of $68 and saying here that it's approaching a margins inflection point.
Not interested in owning Bud. It's not even about the woke stuff, which obviously, they made a mistake and we watched sales fall off a cliff. It's more just that margins are probably going to be getting squeezed here too on these types of companies. I mean, consumer staple, Bud is basically a consumer staple. We have seen what has happened to consumer staples. This stock really hasn't sold out that much, considering if you took the woke stuff out of there, the stock probably be up at all-time highs. So, I mean, I just think Bank of America's wrong here, and I wouldn't be buying Bud.
It wouldn't be at all-time highs, Dennis.
You don't think they knocked $10 off the price for the woke stuff?
Well, that's not all-time. You said all-time highs.
Oh, sorry. I'm looking at the last 4 years. I didn't go back far enough.
Yeah.
So,
okay. No, that's fine.
The last 3 years. So I'm looking even the 2023 highs of $65. So just looking at that, 65, 66. If they take that sell off from May from the 66 to the 56 was all the woke stuff, 100%. Because we saw the sales fall off a cliff. Budweiser just doesn't go down like that out of the blue. I mean, that was all the woke stuff. But now you're in this consolidation, and you broke down, and then you bounced up a little bit. Now you're getting a check back because of the rating here. I think it's more of a selling opportunity than a buying opportunity.
You got gaps to fill here. Just like spotty trading here at the 55.68 level. What I would like to do is there's a little bit of confluence there. You had a high at 56.78. Ooh, that's another 55.78, right where it's trading. That's your 4-day high. After that, it really opens up in the 56 handle. But first things first, $2. That probably is more than its average trading range. So you're really going to need someone really convinced off this Bank of America to continue this rally in Bud. And if you were a bottom fisher the last 2 days, leaning on a double bottom, this is a nice little scalp, a nice little surprise. So we'll see if we can get through that 50, get to that 56 handle with a big bid, and things could change a little bit.
I wonder if Bill Gates will buy some more of it. Of course, he's the recent investor that went big. He bought 95 million of it, and that was on Wednesday, September 6th. So we'll see what happens if he comes in for more. But what
Bill
happened
Gates still short Tesla?
I don't know that one. I had to take a look into that one. Probably not the best.
Bill Gates trade has been a pretty good one there, because we know he put the big short on Tesla there, and obviously that didn't work out that great for him.
Yeah, I don't know what happened in 2016 and why they started coming down. I know I started leaving college around that time, and maybe, we drove it up, and, as I left college, they didn't sell enough Bud Light anymore.
You know what it is? I think it's just like that. People are drinking other things, like what?
Other options, right? Other options, right?
Yep.
And then that also ran into all that craft beer movement, right? That's probably what happened too.
That hurt all these companies, the craft beer movement. I mean, my fridge was full of Bud Light and stuff, and it's got all kinds of craft beers in there now. It's just fun. It's fun. Like, what are you drinking today at different craft breweries? So it's hurt them too. I've always been a Miller Lite fan. I was a Miller Lite fan even before Bud Light, so I'm still going to stay the Miller Lite fan. But Bud Light tastes fine. I drink a Bud Light. I don't care either way. But Miller Lite's my beer.
Let's talk about what happened yesterday, right? We did get a bounce in tech. Some of these stocks bouncing more than others, some that are on my radars. Of course, I'd ask you guys, is this just another bounce to be sold? But one stock that's starting to catch my attention, I wrote it up for one day. I haven't traded it since then, but ARM ARM is starting to finally turn around and go green a little bit here. Is this what's turning around the tech trade a little bit, maybe?
Yeah, I think so, Mitch. We bounced off of 50. It's a psychological level. You actually put a triple bottom in there basically from just last week. So, and then now it's getting a little bit of a lift here. I think just seller exhaustion to a certain extent. I mean, we tried to call this, 2 days too early, Joel. Me and you wanted to get bullish. I tried to buy a bunch of stocks, got stopped out on some stuff. And, and then we went down another 50 S&P handles here. But seller exhaustion. We were due for a bounce. We were oversold. Is this like the start of the new bull market? I don't think so. I think there's going to be another retest of these lows coming. So I don't think you need to like, oh my goodness, I've missed the bottom. I think it's going to come back. I think we're going to come back down here. I just still think the economy is falling off a cliff. And I think a lot of that isn't priced in. But we were just way oversold. We don't go straight down. I mean, we sold off from 450 SPY to 420 SPY in 9 trading sessions. That was one of the most vicious sell-offs of the year. So we needed a bounce. 7% fall off in 9 days is significant. A check back to like 435, the 50% retracement. That's where you start unloading everything you just bought. But don't get married to these positions you bought yesterday, because I think there'll be a retest of those lows.
Real quick, ARM, you had the big move. You went up to almost 70. You went down to 50. I'd say right now, I mean, not a clear path, but I could see it get back and fill in that gap. Bernstein sacked it on that third day. It came out and hit it, had the momentum. Why not? Why not do a 50% retracement? See if you could get in, hold $60, and then work its way again. But once again, Eric Kroll telling us you're good. You see those beautiful candles on the first day, but you almost always get a shot to buy it below that opening price, that IPO price. But there it is, trading up in the pre-market session, 41 cents.
I think that's good advice.
Get ready, team. PCE is coming.
Oh my gosh,
Don't miss it. Get ready. In just about 2 minutes, we'll definitely get the Fed Reserve's preferred inflation metric. We'll take a look at this. PCE, core PCE advancing 3.9% year over year is the estimate here in August, and gaining 0.2% on a monthly basis. And we'll also be getting more economic data to come in. Pay attention to that. We'll get the Michigan consumer sentiment later today at 10 a.m. Don't miss that. Of course, you guys can keep up with all that with Benzinga. We'll see what happens today. Of course, I will be watching especially that core PCE to see what happens there. Of course, that excludes energy and food. So maybe that one could be the one that could make things look a little bit better. Let's see what happens here. What are you guys expecting to see?
I'm going to go wide. I'm telling you that, because we could move here. I don't know. Yeah. I think it could come in. If it comes in a little bit hot,
I know this is.
We get back this rally in a hurry, but
let's see. That's the hard part,
little
right?
Silver lining market here right now. Let's see. It's breaking right now.
Yeah, a little part of me was thinking earlier in the week, did the market kind of front run this PCE number?
It looks light. Looks a little bit light to me. You're popping. So. You just made a new pre-market high. Something's going on here. 43.65. Someone has an opinion. At 65. To me, the initial move was up. So I'm calling what I see here. So inline or light is my guess, or if it's more, it's not too much. But what do you got, Mitch? Come on. Personal income spending, PCE me.
Dun, dun, dun. Core PCE here at 0.1 versus 0.2 estimate. U.S. core PCE year over year at 3.9 versus that 3.9 estimate. Prior was 4.3. So we came down just in line. That's going to help things look a little bit better, at least I think in the short term. PCE price index year over year, 3.5 versus the 3.5 estimate. So it seems like things are coming in line there. Month over month, 0.4 versus 0.5 estimate, prior being 0.2. That's not the worst estimate. At least that did show a little bit of a jump, but not a massive jump, right? It didn't go over the estimate there for the month over month.
We're at the top of this. Like, let's just take it to rates here. And inflation is pretty much licked, like at least in the short term. We have wage inflation happening, so we have some other issues here. But short term here, the Fed has every reason to slow her down. So we're not at a pivot. We're just at a pause. Like we're going to get one more hike potentially, and then it's done. So what I did yesterday, Wasn't going and buying stocks here, but I was analyzing. I'm like, these bonds have been absolutely just hammered on everything. And I'm like, let's just analyze this. Are we going to 7%, 8%, 9%? Hell
No.
no, we're not going.
There's no
They
way.
can't go that high. We got
It's
$33 trillion in debt. So if you think the yields are going, to 7, 8, 9%, I think you're crazy. So I think we're at the top of the cycle. So I went out and I actually did buy some bonds. All the cash that I had moved from bonds to cash when I was worried about this, going up here. I think there's a time to say that rates are probably more near their highs. And if rates are near their highs, that's good for bonds. So I actually went in, I did buy the TLT yesterday in my long-term account. I also bought Canadian equivalent, basically the TLT, with a bunch of provincial bonds in there, locking up these longer term rates. Some of these provincial bonds are like 4.95% right now. And I also went and bought a Loblaw's preferred stock, which hasn't been this low for like 20 years or for like 10 years.
Blah. Wait, I just got to interrupt you. Blah.
Loblaws. That's the biggest grocer in Canada.
How do you spell that?
Loblaw apostrophe.
You can't make this stuff up sometimes.
Okay. I just, because you said it 5 times on the show yesterday, and because there's a Wawa's. Isn't there a Wawa's?
I love Wawa's.
Not in Canada. There's no Wawa's.
Okay, I'm sorry.
I love Wawa's.
But anyways, Loblaws, it owns all the groceries, so it all owns all the independents too. So you think you don't, I don't go to the, you go to the superstore? Well, that's Loblaws. They own, basically it's your biggest grocer in Canada. It's, equivalent of Kroger, if not bigger, like for Canada, because Kroger's always got more competition. There isn't that much competition in Canada. So anyways, preferred stocks yielding 6.6%. It used to yield 4.5%. So I'm like, this, and you can say, well, why are you going into bonds for 4.5 or 5%? You know why? Because if rates start going back down, you don't just get 4.5, 5%. You get that recovery rally. So like if the TLT rallies from 88 to 100, well, I just made 15% on my money.
Yep.
So it isn't just about the yield. It's also about the possible pop up. So I think that's where I'm putting a little bit of money to work. It's a cautious way to say that the Fed is getting close to being done.
Yeah, that's an excellent point. And also, like, you look at this TLT and in the chart there. I mean, we don't use the term like mean reversion a lot, or we talk more retracements. But man, there's got to be some kind of mean reversion in here somewhere, right? Or some kind of retracement. And then the other thing, Dennis, because you were on the closing print with me, and I was thinking about your bond move, and then I'm thinking about my portfolio, which is have some bonds that obviously haven't done very well. But like just the concept that you can get, rates right now, you can get 5.5, 6% right now. You can get that, locked in T-bills or whatever you want. And now you got a chance to get a bond yield near that, or a dividend yield.
Bond yield's always better than, because you get that possible appreciation in price. I mean,
have you ever been?
If you're in Canada, it's L.PRB because they do the dot on preferreds. L.PRB, and it was $27 before all this started. 25 par, but it was trading 27 because they had the coupon was a little bit. I think it was like a 5.5, and they had it down to like a 5. Well, it's down to 20 even. So if it comes back to 25, well, 20, I pick up 25% there. Plus, I'm getting a 6.5%. So, I mean, it's not a bad, I'm not going in here trying to make 50% or 100% of my money, but it's more attractive at cash at this point in time, I would say. So that's why, it's some of this stuff that I'm like, not putting it to equities, but putting it out in there to work and looking to get some appreciation on the price of the bonds as well, maybe. I think the bonds are dirt cheap.
And can you ever remember a time during your investment life where, you've been with this kind of scenario, where, with solid rates, you could get, 5.5, 6%. And then also, with your patient, with the bond market, something like that, you can get, some kind of a similar yield. It's just it seems like it's like nirvana. I mean, I know people want 15, 20, 30%. They want, the big runners and things like that. But I mean, it's just, I'm trying to think back when we've had this kind of, opportunity. So We shall see. We should see what Ryan Detrick has to say about this.
Bring him in.
Where's Ryan?
You don't see me?
There you are. You got your ball cap on. There you are.
I'm just sitting here.
Gear? You're supposed to be wearing Lions gear today. This is ridiculous.
I tell you, that was pretty impressive last night. I'm wearing my podcast. We got these T-shirts. I'm just blindly or blatantly hyping up my podcast. So
tell us about
what did you
that,
say, Dennis? Blah blah. What are you guys talking about? I can't
right? Blah blah.
Right? To Canada? Have you never been to Canada, Ryan?
I have.
No.
I mean, listen, I was 19 once. I used to go to Windsor when I was 19. I know how Windsor was.
You went there to drink. I get it. That's all.
Yeah,
Drinking age is 19.
Exactly.
He was down there stomping Windsor's streets when he was 19 years old. Yeah. I probably bumped into you a few times out there. I didn't even know you back then.
Probably
still wearing the same shirt.
More like stumbled into you.
Yeah. All right. So how you guys doing? Everybody good? You're celebrating the victory by having fun today?
Yeah.
We're having fun.
I've got some charts for you. Let me see if I can figure it out. So I can share screen. Here we go. Give me a second.
Yeah, let's get to the stats. The
Windows.
stats.
Statman do.
Of course, like always, I always say, and we always say this, that nobody knows where the market can go, but there's nothing like stats to try to help you, right? Try to get you an edge. Let's get. We're
gonna try. I threw some stuff together. Hopefully, you see that. You see this just happened. You see that slide? I hope.
Yeah, it happened.
Perfect. So, I mean, I know some people talk about this. Bespoke was on it. I mean, you guys might have been on this. The SPY has been trading since 1993, right? S&P 500 ETF. Made a lower low 9 straight days until yesterday. Yesterday we bounced. I did see PCE just came out. Looks like it might be bouncing a little more. So maybe, who knows? Maybe up again today. But 9 days in a row, we made a lower low. Super small sample size. I will admit, people get mad when I point sometimes these things out. But it is what it is. Look at your screen there. A year later, you got some big returns, and I get it. Look at those dates. Those are some rough times. But, hey, we've just had, a little bit of rough time. So I think it's just something I wouldn't ignore, the fact that maybe, just maybe, this is like a flush out, right? A major flush out. I've got some other things I'm going to talk about here. But it's just interesting that this just happened where we had 9 days in a row, a lower low, be open to the idea, that's what I'm going to talk about, for a fourth quarter rally. And that's kind of one thing to be aware of. I've shared this chart, I think, every time I come on with you guys for over a year and a half now. I'm going to do it again because it's just amazing at how well seasonality's played out. This is the presidential cycle. The previous 3 quarters are supposed to be strong. My goodness, were they? This quarter wasn't all supposed to be that great. It wasn't. I come on with you guys, all year saying rally, rally, rally. And then like in August, we saw these, but remember when I talked about, Mike Wilson saying that was like 2019, and then they all upgrade their targets. This was like at the end of the middle of the year. I'm like, oh my goodness, wouldn't it be something if we finally had some volatility and a pullback because all these bears turn bullish?
Yeah.
Amazing how this happens. Anyway, so now we're still optimistic though for a fourth quarter rally. Because it's seasonals, I'm going to talk a little more about fourth quarter rallies here in a second. We'll skip that one. These are some charts I share on Twitter. People like them. This is a pre-election year. What's your average pre-election year look like? Well, it would have been perfectly normal to have a rally early in the year. Remember every strategist on TV, or almost every strategist on TV, was saying how there wouldn't be a rally the first half of the year. It'd be the second half of the year. You just look at the numbers and the stuff we talked about on here and say, hey, the first half of the year is usually strong for a pre-election year. It's later in the year things get choppy. And sure enough, that's played out. We're optimistic, though, as well as some of these things have played out. We're still going to get the upward bias into the fourth quarter. Likely, in our opinion, we've been overweight equities all year. We're actually looking to buy in here. We're talking about adding a little bit more. So we be a tad more overweight here for a fourth quarter rally. Similar chart. This is if you're up 10% for the year at the middle. So a good start to the year. Kind of looks the same to me. Choppiness is normal around here. It's also normal to have some end of year strength. The credit markets, this is triple B spreads. Get the chart straight from Y charts. It's shocking to me, I'll be honest, that triple B spreads haven't shown more stress than they are. That, again, a sign that if there's a monster under the bed, you'd probably be a little bit more worried about the lower graded companies paying back their debt. People aren't. They're not charging more yet. And yet's the key word. I get it. But I think it's another clue that this seasonal weakness we're had with 7% pullback, give or take 6-7%, whatever it was on the S&P, is just kind of normal, right? It's not a reason to panic because we're not seeing the credit markets panic. a chart I share on Twitter. People love this one. It's if you buy any random day, how does the market do 10 days later? Well, listen, we just are in the midst of the worst, okay? You see it there. Like the worst 10 days of the year are what we just are about exiting, like right about now. So, again, it shouldn't be surprising. And I get why. I mean, listen, people say, why? I mean, I don't know. I don't argue with it. I just know the end of September, and it could be the Jewish holiday. It could be, I've heard hedge funds stop trading, their fiscal years in October, maybe cleaning some books in September. Whatever the reason is, we knew the end of September probably could be a little rough, and it has been. Now, the good thing is you see some more green coming up. October 28th is my birthday. If people like to see what day their birthday is, that's a pretty good day to buy. And if anyone wants to send me a present, I'll take it. Here's a couple more. So this is getting a little more in the weeds, but I know I got some traders. People understand this stuff. MACD histogram, right? The MACD histogram just flipped bullish. Let's see, I guess in early August. In early August, it just flipped bullish. This is a monthly MACD, okay? It was negative for more than 6 months. Now, that's people talk about this bigger picture, but the MACD line stayed above zero. And I know that's kind of confusing. Hopefully most people understand what I'm talking about here. We didn't see that in like the financial crisis and the tech bubble. So there's some underlying strength potentially. And when you have that scenario, that's what I'm sharing on the screen. More than 6 months of a monthly MACD histogram negative flips to bullish like it did 2 months ago, but the MACD line stays above zero the whole time. It is what it is. Check out the returns there. Pretty strong forward performance. Yes, the last 2 months have been a little choppy, a little rough. This would be saying, hey, we might want to be thinking about seriously buying the dip potentially, and that's the camp we're in. Just another good chart. It is what it is. October tends to be known for a lot of things like bear markets. It's not all that bad of a month, but November and December are really strong. Just kind of, again, things to think about. Now, reason you guys invited me, a couple more on fourth quarter, then we can chat. Fourth quarter is strong quarter, right? Up 4.2% on average. It is what it is. Twice, how do I word this? Twice as strong as the next best quarter. The first quarter there, you see it there, about 80% of the time. Something to think about. But here's some other things to layer on top of that. When you're down at least 1% in August and September, like we are, right? We're going to be this time, right? That's seasonal weakness. It's kind of normal. And this isn't even looking at how the year is doing. This is throwing everything else out. Just if you have seasonal weakness in the months that are normally not that great, check it out. Fourth quarter has been higher 12 out of 13 times, going back to 1950, up 7% on average. Just something to think about. The seasonal weakness isn't a bad thing. Just the last couple of years, right? Bespoke had a cool thing. September's been bad, like 4 years in a row now. Well, the fourth quarter hasn't been. So again, just because September's bad doesn't mean you can't have a fourth quarter rally. But this is about the last one. If we're in the sweet spot, up between 10 and 20% for the year, like we're going to be today with a little bounce, it looks like. For a while there, it's like, ooh, we might not be above 10%. The way September is looking, but we're going to maybe have an end of month bounce. Another one, you're up a little bit. What is it? Fourth quarter is up 5.1% on average. So a little bit better fourth quarter returns when you're in that sweet spot, up 10 to 20%. Yes, when I do this way, it takes out 87. 87, we're up like 30% for the year or something like that going into October or something like that. So yeah, that took out 87, but I don't think we're in the same scenario as 87 because the market's pulled back and, we're in that kind of sweet spot. So that's just something to think about. Last one, I believe it's last one. The government shutdown. I've done a blog on this and shared this. Everybody's talking about it. Yeah, I mean, it's not great to have government shutdown. You want to get a passport, want to go to a park. People aren't going to get paid. I mean, those aren't good things, okay? But the market looks past it. It is what it is. Gained 10% during the last shutdown. Yes, the Fed did the pivot in late 2018. So news trumps charts. We understand that. But usually these are fairly short. I mean, you can say what's one of my worries. Maybe the government shutdown lasts longer, right? I think and Ned Davis came out and said every week will take away 0.1% from GDP. Now, when you open it back up, people kind of go out and the government spending comes back and you kind of make it up in a hurry. So maybe an extended shutdown could cause a little volatility. I wouldn't be too worried though. And honestly, usually the market looks right past it. Well, there we go. I'll breathe. Those are my charts, guys. What do we think?
Holy, the information station here. Man, Ryan Detrick, Statman on fire here today. And
you guys got a little break there, didn't you? I gave you a break from talking.
Next time, let me know. I was ready to bounce.
Turns it around. This guy, man, gives you, so much food for thought. I'm like just trying to digest it all here right now, and I don't even know where to go with the question here. I can go anywhere.
Football. Want to talk about football? I don't know.
Well, we could go back to football. Let's
don't talk the Bears. So. The Bears aren't doing good right now.
Yeah. Let's bring it back to stocks and bring it back to sectors here, Ryan, because we have had a pullback here. There has been a dip here. And where would you be looking if you're looking to buy the dip? Because, I mean, the dips in the IWM and the QQQ are much different. The IWM is almost all the way back down to give back all of its gains for the year. I don't know what the IWM's up on the year, but I think it's almost nothing.
Right.
So, like, I'm just looking where it started the year. I'm just trying to
nothing.
get the chart here.
Nothing.
It's basically nothing. It might be up 1% for the year, and then you got the S&P up 12%. Would you stay with what's working with the S&P, or would you start looking through the small caps and say, hey, maybe there's a catch-up trade here?
No, great question there. And I'll put it this way. We're expecting the catch-up trade. We have been overweight small caps for maybe a quarter and a half or so approximately. So it hasn't worked the last 2 months. I mean, there's no question there. So I'm talking my book or not, but we just don't see a recession, right? We think the reality is the Fed is likely done. You guys are just talking about some of this stuff. We think there could be a catch-up trade. Historically, small caps do really well in the fourth quarter and the first quarter of a pre-election year / election year. So those are some things we're looking at. And again, I know this is a lot more shorter term traders on this call, but small caps are about as cheap as they've ever been relative to large caps. So large caps are a little pricey. We've been more neutral technology. We've been more overweight communication services. We thought, tech's probably going to come back to earth a little bit. Doesn't mean it has to stop going up. Maybe just go sideways or so. And some of these other areas, cyclicals, we like cyclicals. I mean, energy's been our favorite group. I come on you guys for a while saying we like energy. Well, now everybody likes energy, but we've been comfortable in that. And we still see some reasons to think energy could do well. So those cyclicals and small caps where we have some small tilts, we run a lot of money for our more than 350 Carson partners, and we've got some small tilts in cyclicals and small caps, and it's kind of do or die. I did that chart summit with JC the other day, and a lot of smart people are on there talking about small caps are a do or die level, and I kind of agree. I mean, there's some reasons that small caps better bounce now, and we have seen that this week. Finally, we've seen some small cap outperformance. I get it; it's only a couple of days, but again, it's bouncing where it should be. So we're following that one real closely.
What about retail? Retail. Oh, I'm sorry, Mitch. Go ahead.
No, you're good.
What about the retail?
Yeah, I mean, consumer discretionary, we're just more neutral on. I get it. I mean, retail, it's a mixed bag. It feels like there's some that are doing great and some talking about theft and shutting down stores. Others are selling left and right. So it's mixed. We're more neutral there. But I will say on retail, it's shocking to me. How everyone says how bad the consumer is. Data we're looking at continues to say it's not so bad. I mean, credit card debt over $1 trillion. We understand. I've shared some charts on this before, but all-time record, yes. But if you look at credit card debt as a percent of disposable income, I mean, it's wildly less than it was like 10, 15 years ago because people are worth a lot more. And I get the argument. Well, that's because the top 1% or top 10% have more. But then you look at where net wealth has come, guys, just this decade, the lower 50% of net income earners, their net wealth has exploded higher relative to top earners. So again, there's different ways to look at it. I'm not saying things are perfect. I'm fully aware there, but I just think we think that consumers in a lot better shape. And that from a structural bull market / no recession call, which has been our call all year. We said no recession start of the year. People were furious when we said that. And we said, because the consumer is in pretty good shape. We still see a consumer in pretty good shape. I understand some credit card delinquencies and things are starting to perk up. It's almost like they're more normalizing, though. They're almost getting where they were pre-pandemic levels. We just had such a unique situation with the pandemic. So we're watching, but we still don't see any recession. Consumer's okay, but consumer discretionary, we're more neutral overall.
Now, one chart that you've been showing, and you've shown this chart all year, and I love that you bring it back, the presidential cycle, right? And we could bring that up if you'd like. I know that you guys have seen it multiple times. And now that it's pointing, we've gotten through that kind of nice raise, nice little lift period, but we're running into the trouble period right now, the third quarter. You said that you see in the fourth quarter a little bit of a lift, but another thing that I'm seeing on that chart is what's coming in the fourth year. Right. Yeah. And what should we be looking forward towards there, Ryan? Can you explain us a little bit what the stats say?
Yeah, I'm failing miserably. Trying to share this. Here it is. Okay, so you should see that. So where was that? That was early. Let's take a look. Here we go. There we go. So you can see be the ones on the right. I mean, historically, year two, midterm years are the worst for stocks. And again, these are just broad swipes, broad conversation pieces. And it's like the new president comes in, or maybe the same president comes in, and you hit some bumps, hit some bruises. But that third, usually they say the economy gets going. You want to push the right levers where we are now to get things, get people in a good mood. But here's the thing I think that's important to note. And I don't have it broken down here, but I write about it maybe sooner and later because I get this question a lot all of a sudden. When you have a president up for re-election, markets tend to do better in that election year. And why is that? Well, you kind of, you know what you're going to get. That doesn't mean they're going to win. I don't want to, I don't want to get too in that, but you just kind of know what you're going to get. Let's look who might run this time. Well, might have the same two guys we had before, right? I mean, don't shoot the messenger here. That could be what happens. Yeah. We know what we're going to get. So we're optimistic that if that is the play, markets aren't going to have as much uncertainty. There's always uncertainty. I understand that. But when you have a president up for election, and I don't know if we've ever had one like this, we might have the same guy who ran before, but the same guy was president before, you know what you're going to get, with both of them. So we're not as worried about I guess election year jitters as maybe some previous years is where we are. But again, the fourth year of the presidential cycle does pretty well. You can see there, this is the first which one is it? The first quarter, not all that great, but you tend to have some rallies, the later in the year relative to kind of the first and second year of a cycle. So we're still in that sweet spot. Here we go. So here's another one. You see with a new president, check out year 4 on the right there. Year 4 under a new president, up 12% on average. That's pretty good. It's when you have a reelected president, like we were talking about there. So like a guy who reelected means they're about out of the office, right? They're about, somebody new's coming in. No matter what happens, somebody's news coming in. So again, that's when you have more uncertainties. I think this is a pretty cool chart just showing from that point of view. Average year's up 7.3 in year 4. But again, with a president who's new, first cycle going through, things do all right. So I think that's important to note.
What would upset the apple cart? What would turn this scenario? I mean, you got a lot of statistics going in. There's macro things that can happen. Is there, what could go wrong, Ryan? What could go wrong?
Yeah, there's a lot, obviously. Yeah, there's a lot to go. Maybe Joe Burrow hurts his leg again. One thing I'll start with. You think about it. The U.S. dollar strength is one thing. I know you guys talk about this a lot. I mean, dollar's up 10 weeks in a row. We'll see where it goes this week. But that's one that's got our attention, that, a lot of dollar strength isn't always good. And the other thing, we've been bullish energy. We're all actually a tad overweight commodities in some of our broader based portfolios we run. We have been for a while. We just think, commodities might do a little bit better, and we've seen that overall. Yes. If oil keeps soaring here, I mean, we've seen what happens in consumer confidence. Consumer confidence and oil are like inversely related. You can throw everything else out. You check out oil and consumer confidence. They're inversely related. So if consumers start getting a little more worried about the higher oil prices, unless they're investing in energy stocks, which most people aren't, that could be one thing that gets us. And that's not our base case. We are still overweight energy. We are still overweight, oil stocks in general. But, that's one that could get us. But again, I'll put a bow on this. At the end of the day, if you say, what are 2 things you watch? I mean, one, I like advanced decline lines, which are starting to show, they're not perfect. They're not totally breaking down. The other, those credit markets, I shared that chart. I mean, I don't know where it is, somewhere in here. Credit, is that it there? There it is. Credit market. There it is. We're just not seeing any stress. Until we see stress, and we watch this every single day, until we see stress in the credit markets and the spreads, then it's just hard to think that this big calamity is going to come like we keep hearing. So we're not seeing that yet. So I'll keep following that over just about anything.
Ryan Detrick joining us here on Premarket Prep. He's the chief market strategist at the CarsonGroup. Always just a great interview, bunch of information, helping traders, investors, short-term and long-term. Thanks a lot, Ryan.
Anytime, guys. Have a great weekend. Enjoy football. Blue. Let's get some green maybe today too. A green Friday. Let's go for it. So see you guys.
Hopefully that calf can hold up there, Ryan.
Hey, we'll see.
Go Blue.
All right. I did want to throw in there some education here from CarsonGroup. If you guys want to check that out, I threw up the blog here, insights that you guys can be checking in, and also keeping up with what Ryan Detrick does on a daily basis, right? You guys definitely give him a follow. Let's get back to the markets. How we looking, Joel?
We're just holding up near the highs of the session. We didn't even get a dip. That was one thing about when you have your numbers. Do I need to share again, or you got me?
Man.
There was
it was light, and they were buying right off the hop.
Yeah. Yep. So
I got some things to look at here for you guys. I was going to bring this up before, but we had Ryan with, he's the stat man. So what I did here is, this is, of course, the BEA. You guys, I can give you guys a link if you guys want to check this out. This brings the recent action, right, of the PCE, right? And so now we're looking at inflation on certain things. This is durable goods, right? Motor vehicle parts, furnishing and durable house goods, recreational goods, and other durable goods here. You can see how this had gone into the negatives. It's slowly working back to kind of break even, where inflation could actually go up, but it's not as bad. Now, when we look at non-durable goods, this is where we're actually seeing inflation come back, right? Where this went into deflation here in the negatives, and just recently now started spiking back towards the upside. So this is what does non-durable goods include? We're talking food and beverages, right? Clothing and footwear, gasoline and other energies,
All the stuff
right?
we need.
All the stuff we need, right? Other non-durable goods. And if we look at gasoline, it did go into kind of the negatives. It was negative 5.5 here.
Yeah.
Now we're all the way back to 10.2. So this showing me that, yeah, if gasoline prices stay up here, inflation's going to start rising.
Here's
right?
the issue, and this is why I still remain cautious on equity markets, despite all the fantastic analysis and quantitative stats from Ryan, is I believe we're going to enter a period where margins are getting squeezed, because I think we're at a period where the consumer is still fairly strong, but they may not have as much money to obviously buy some of the bigger ticket stuff. There may be more less discretionary purchases. So it's all supply and demand at the end. What you can charge for something is what somebody's willing to pay for it. But if we have increased labor inflation, which we're seeing everywhere, obviously UPS, the GM, Ford strikes, we're seeing, the government shutdown, we're going to see, increase in labor costs across the board. And if demand isn't increasing as well, that probably means margins are going to get squeezed. I mean, that's why Workday fell 10% yesterday, was because they worried about margins going from 30% to 25%. I mean, if we have margins start getting squeezed here, those corporate profits are going to get hit. And if you start seeing earnings warnings coming on margins, and as we enter earnings season, that's my concern going forward here. So I do think it's nice to get, a nice 90-point S&P rally from 3 days ago, which is fun. And, it's nice to, make some money, buying the dip and stuff. But I still think caution going forward here, because I just don't see us going back to all-time highs. Maybe it's inflation. Maybe everything just keeps going up and people find the money. Maybe the labor that they're, the increased wages, it's going to move right back in the economy, and that's going to drive demand. But I think we could enter a period where margins start getting squeezed.
And we're entering a little bit of a quiet period here. We have the unemployment data coming out next week, and then inflation data a little bit later in the month, and then you start to get into Q3 earnings season. So sometimes it's like in the absence of bad news, right? It's and something no really negative catalyst. This is something that the reaction that you get in the market, and you could just have this kind of slow rally until you get more fundamental information. The most important will be the inflation data coming out, I believe, on the 11th and 12th. We'll be talking about that with Blue Putnam. And then I believe JP Morgan, I believe it's October 16th. Don't quote me on that. But here we go again. And, Delta Airlines, if you would have been following Delta Airlines on its, the
What
best
the CEO
earnings,
was saying.
Yeah. I mean, contrarian moves. So we'll see what happens. But we do have more fundamental information coming, but it's not going to be another, for another 10 days, 12 days.
Yeah.
So
So you have a relief rally here. This is a dead cat bounce, your classic dead cat bounce relief rally here. Think about the 50% retracement, get up to like 436, 437. I think you're unloading. I think you get this relief. I think if you bought stocks 2 days ago, I think you're unloading into this today. I think you just got to be cautious here. I just don't see the setup. And again, I'm a trader, so and I may change my opinion here, but the one call that I am willing to make, and that I made yesterday, is that I still think rates are near their peak. I don't think we're going to continue to see the long end just going sad. Like, where are we on the 30-year? 4 and change. We're not going 6-7%. I just don't see it.
That's what Jamie Dimon said. That's what Jamie Dimon said.
I know Jamie Dimon is wrong. Jamie Dimon is wrong. We're not going to 7%. And you can say inflation's here to stay. Sure, there's going to be some inflation here to stay, but we're not going that high. This is the servicing, not without the economy really falling off a cliff. So, and I think if the economy really falls off a cliff, the Fed starts to really back off and starts to actually pivot and starts to cut rates. So the call that I'm making yesterday and today is that we are at peak rates, very close to peak rates. And that's what I was buying yesterday, bonds, trying to profit from the call of we're at peak rates and rates are going to start to come in. So if rates start to come in, I'm going to make money on these bond purchases. Like I said, what I bought yesterday, I can repeat it. I bought the TLT, I bought some provincials and, an ETF in Canada, which is equivalent to a bunch of government bonds too, which are yielding up words of 4.5% from like 1% 3 years ago.
I know,
So I think and then the Loblaws preferred, you guys make fun of me on that one, 6.5%. I mean, again, it's not going just for the 6.5%, folks. It's going after the fact that if rates start to come in, I'll get appreciation in those bond prices.
Blah blah money, man. Just blah blah money.
Yeah. And this is just kind of, what I hope I, expressed myself clearly last week with like the reaction to Powell and everything. I mean, he basically stayed where he never changed his stance. He said he may go another quarter. He didn't do anything to me to change, what the plan has been. But it's 9:01 here. We got to wrap things up. We're at the highs of the pre-market session, which is to slow drift up. Believe it or not, if we get back to 43.83.50, that's only 15 handles away. That's Monday's high. We'll be all the way back at all this doom and gloom and everything. Monday's high was Monday's high was 83.50.
What an opportunity to get out. What an opportunity to get out. If you're really sitting there on leverage, margined up, and you're like puking your guts out 3 days ago, you're getting a nice gift here, man.
43.61 was where we closed last week. If we close, we could close green for the week after the debacle that we had earlier. But that's it for me. We're gonna hear from the cow guy. Well, you tune in at 8 o'clock to hear my intro, and then the cow guy's coming on. Scott Schlady will be on at 8:05.
All right, Joel's getting out of here. Dennis is getting out of here. You ready for this market, Dennis?
Yeah, I think I'm selling the rip today. I think I'm getting in here and just, lightening up some stocks. If you're in there, maybe there was a few that you don't like and they're getting a nice lift in here. Again, it's stock selection here, though. Like the one stock I'll just say is I'm still very nervous about Apple. You're getting a nice pop in Apple here. This iPhone overheating is going to be an issue here, too. I mean, just think about how much the upgrade cycle. It's all about the upgrade cycle, and everybody's going to want the 15. I just heard it's overheating. I said with my wife, like she was talking about the, iPhone 15. It's like overheating. It's like, well, maybe I'll go to 14 or maybe I won't, go at all for the, this time. I mean, how many other people are saying that same thing? Apple needs people to upgrade their phones. That's how they produce the amount of cash flow that they do. People are nervous to upgrade, man. That's not a good thing.
All right, guys, we'll be wrapping up in just a second here. Now, one thing that I wanted to point to right quickly is financial services. Are you still seeing weakness there, Dennis, that we should maybe be concerned on?
Sorry, what was the question again here, Mitch?
Financials. How are you seeing the financials?
Still nervous about them. I mean, they haven't participated. The IWM is still sitting here. We can say how much of a rip roaring bull market here, but the IWM is flat on the year. I mean, that's the majority of your stocks. So it has not been a great year for stocks overall. It's been a great year for tech. It's been a great year for mega tech. It's not been a great year for stocks. Gary's given it all back. I mean, if you've been investing in banks this year, you're doing really bad, man. KRE is down on the year. BAC, we're just going into the banks. BAC, I believe, is down on the year. If you've been investing in banks on the year, you were losing money. And, and you're watching this market go back right straight up, and you're like, wow. So, I mean, a diversified portfolio hasn't done great this year. What did great was heavy tech. That's what did great this year. So is there a catch-up trade for banks? They always say, is there a catch-up trade for banks? They just perennially underperform. Since the financial crisis, it's just been a bad bet. Unless you're in JP Morgan, there's a couple of big winners, but just the banks. And if you look at the Canadian banks, holy, what a disaster they have been. I mean, just, you're looking at them from the last 2 years. A lot of these Canadian banks down 30% from the highs. And you think, oh, yeah, well, the markets, it can't get better. The consumer can't get stronger. Well, what happens if the consumer weakens on these banks? What happens if we don't continue to just have this rosy scenario where the consumer is strong? Consumer remains strong, but are we in as good as it gets? I mean, we got to keep asking ourselves that question, because if you're not in this as good as, if you're in this as good as it gets environment, your stock's not going up in this environment, what's it going to do when it's not as good as it gets? I mean, that's what makes me nervous on Disney. Doesn't even participate in the rally at all yesterday. I mean, what if, the consumer starts to not go to Disney World all of a sudden? Now that cash cow that of all your parks that has been keeping all your other crappy businesses alive starts to get hurt too, then you've got a problem. So, I mean, parks is like 55% of their revenues. So, I mean, we can complain about ESPN and all that stuff all you want, but it's water under the bridge. It's the parks that matter. People stop spending, their $150 a ticket to go to Disney World. Then Disney's got problems. There's a reason that stock's not participating. There's a reason, there's a lot of stocks that aren't participating. So I think you got to be very selective with what you're buying.
Now, you guys out there, we get all this insight from Dennis Dick. Give my man some love. Give him a nice follow. Triple D Trader. Go do what you do best, my friend. Get after your trading action and enjoy your weekend, Dennis. Have a good one. All right, that's going to do it for us. Coming up, live trading. Don't go anywhere. Stick right here for your live trading stream.